Hey folks, hope you all are doing well. I'm Karan Bandal from Econosite, your weekly economic wrap from India and around the world. So let's get started with China. China's economic slump spills into the global milk demand, China's property sector, and the German connection. A neutral observer takes in Chinese official data on its economy with a little grain of salt due to the opaque nature of how Chinese institutions operate. China's economic growth for the quarter ending on June 30th, 2023 missed expectations by a whopping 100 basis points. That is, according to the Chinese official numbers. One wonders if the magnitude of the slowdown is even larger. Here is why. Let's start with the global milk market. A glass of milk or feasting on baked goods could soon cost a lot less. Reason? Chinese appetite for dairy products, which plays a key role in setting the price of dairy markets globally, has been slipping this year. The average price for a ton of milk powder has tumbled to its lowest level since June 2020 and now is down nearly 40% from its March 2022 peak. The slide could mean Fonterra, the world's biggest dairy exporter based in New Zealand, will face headwinds and slash payments to its suppliers this year. This is precisely why the world watches China, because the movements in the Chinese economy may reverberate in different parts of the world. Now look at China's domestic property sector. Bad news keep coming for the troubled sector, with Shimao Group, one of the country's many developers that have defaulted on their debt, announced crushing losses. Shimao Group has finally released its financial results after a 16-month delay and various threats to delist the company. See, something like this, that is, withholding key financial information from investors, will never happen in the US financial markets because regulations here are potent, and despite all the criticism, corporate culture tilts towards transparency. So, Shimao Group posted a $6.8 billion loss over 2 years. After trading in its stock resumed for the first time since April 2022, shares in the troubled firm fell 67%. Last month, the infamous Evergrande, China's largest developer, announced a massive $81 billion 2-year loss. These results are symptomatic of a wider crisis facing the sector. Property sales by floor area fell 28.1% in June from a year ago, marking the largest drop of the year, even worse than May's 19.7% decline. Property is vital to China's economic health, as this sector makes up around 20% of China's GDP. A fall in house prices, a drop in construction starts, and a fall in real estate investments have all heaped misery on the home building industry and the Chinese economy. So what's the German connection? For that, let's look at German exports. For the first half of this year, China featured at 4th place as Germany's exports destination. In these 6 months, Germany exported goods worth around $886 billion, with exports to the United States up by 4.8% and to China down by 8.4%. Things weren't as bad with China if we go just 3 years back. China made up 7.9% of the total German exports back in 2020, peaking that year. This has also been on a steady decline, with China now making only 6.2% contribution. The fall amounts to around $30 billion decrease in China's demand for the German goods this year, and that surely is contributing to German manufacturing sector suffering, with manufacturing PMI collapsing to 38.8 in July, which means a severe contraction for the manufacturing sector that makes up about 20% of the German economy. China is an export-led economy. Continued weakness of China's economy is even more evident in the most recent trade data. Its exports fell by 14.5% in July from a year ago, while imports dropped by 12.4% in US dollar terms. This drop was worse than what analysts had expected. Look at the widespread fall in China's dealings with other economic centers around the world. China is consuming less raw materials and sending out fewer goods to other countries. As a result, China's manufacturing sector is also suffering, with July manufacturing PMI coming in at 49.3. This is the 4th successive month of PMI registering a value less than 50, indicating a protracted manufacturing contraction. The far-reaching negative consequences of China's economy struggling to find its footing post-COVID makes one wonder how bad the macro numbers truly are. On to India update, India's GFCF boom. We have spoken about GFCF in the past, but let's do a quick recap. GFCF stands for Gross Fixed Capital Formation. It is a measure of investment in the economy or asset creation. Assets like land improvements, plant, machinery and equipment purchases, construction of roads, railways, private residential dwellings, commercial and industrial buildings, etc. This also tends to trigger a multiplier effect in the economy, where the multiplier effect leads to a higher growth in the economy in the longer term, thus creating a sustainable growth momentum. We want GFCF in the economy to be higher. Now look at GFCF trend in India starting from fiscal year 2015. It has been on a steady rise, understandably falling during peak COVID but then picked back up right away. In these 9 years, GFCF has risen by over 65% or at the rate of 5.77% each year, coincidentally matching the average growth rate of India's GDP for the last 9 years. The center is also encouraging capital expenditure on capital projects pertaining to sectors like health, education, irrigation, power and so on by releasing special assistance in the form of 50-year interest-free loans to different states. All this bodes well for India's growth in the medium term at least. In summary, China is struggling. The factory of the world is seeing its key sector, manufacturing sector, contract. It could be either the global economic slowdown, US-China trade tensions, or China's own zero-COVID policies that are responsible for this China problem, or it could be all three. In case of India, we get peppered with some positive macroeconomic data almost every week, the most recent one being the robust growth seen in asset creation in India's economy, which positions the country for a sustainable GDP growth. I hope you found this week's wrap interesting. I'll speak with you again next week. Until then, take care.